very much. I'm going to start out. As you all know, this panel is the Journey to Net Zero, and it's about responsible investing and optimizing portfolios. How many of you in the audience believe that net zero is possible? Raise your hand if you believe it's possible.
By when?
2050 seems to be.
By the target dates that have been established. How many of you believe net zero is even possible? How many of you think it's impossible, unrealistic? Interesting. Thank you so much. Marina, I'm starting with you. The targets are fairly nebulous. What do you think?
I am surprised by the even split that I saw in the room. The targets are nebulous if you start to start digging a bit deeper, especially on the corporate pledges or the company pledges in terms of net zero to 2050. For me, one thing, to answer your question in terms of is it possible, the operative word when it comes to net zero is the word net, right? Because it communicates a balance. This isn't about eliminating every single piece of emission. This isn't about, getting to absolute zero emissions, because that is not possible. However, what is possible is to look at the technological opportunities that exist to lower emissions to a level where you cannot lower any further, hard to abate sectors, as we call them in the industry, then you have to start offsetting emissions. So I think the idea of net zero is one that communicates balance. It was one that communicates a sense of transition over time, especially as technology starts evolving. And that is what makes it achievable to a large extent, because if it's impossible, then why are we even talking about it? But I think it's that. But and you said they're nebulous. Yes, on a company level, a lot of the times I think we have seen historically a lot of these pledges are made with a 30-year horizon, and yet yes, a lot of them tend to lack a plan or substance. That is changing. Well, we can talk about it a bit later, but I think some of that will be changing soon.
And we'll talk more about data. Kristen, I'm going to turn to you now. Our colleague was talking about the fact that not to think about ESG is kind of a failure of risk management. And I think that's at the core of what our firm believes in. Do you think the markets are pricing in the risks, especially the risks that are associated with global climate change?
Well, great question. I'm sure many of you who are here for the first panel this morning heard from my colleague that ESG risk is actually a risk framework, or ESG is a risk framework. And therefore, we use that, integrate that through investment process to determine both risks and opportunities. But in doing so, I think we realize that actually climate risk and sustainability risk, which is investment risk, is not actually priced in. And one of the things that we've seen is the duration of investments really having an impact on how we evaluate that ESG risk. Because it's different if you can hit the sell button, if you own something and you determine that it actually has significant climate risk, and then you can sell it. But in private markets, our window is much longer. We have a long-term investment horizon, and as we look towards that, we want to sell something in 5 to 10 years. So you need to evaluate what that climate risk is now to determine what your actual exit might look like in that 10-year period of time. So no, I think is the answer. We need to do a lot more work in determining what that climate risk looks like and integrating it into our due diligence processes.
Sachee.
Yes.
I'm turning to you now. Both Marina and Kristen are fairly top-down. Yes. You're very micro, bottoms-up, public markets. How different does your portfolio look today as you incorporate more and more ESG considerations than it did a few years ago?
Great, thanks. So you'd be disappointed to hear that my portfolio actually does not look different. And the reason being because as an India fund manager, for me, ESG is not a marketing gimmick. It's not a, something that you put a green paint on something. I think it's a genuine business risk. As an example, if you're a paints company and water is one of the key raw materials that you use, and if you are not managing the fact that you are in a drought-prone country, then I think it's a critical business risk. Alluding to your previous question, as an investor, it is my job to price that risk and make sure that I'm putting my fund's capital only in pockets where the management is keenly aware of the risks that these challenges pose.
Can you talk a little bit about, we're talking about both risk and opportunity. Are there whole sectors that you would avoid? And if so, what are they? And are there sectors that you're more bullish on given your ESG lens?
Sure. I think so insurance is a sector that I think one has to be very careful about, because as an investor, I need to be sure that the managements of the insurance companies are aware. Earlier this morning, I think there was a gentleman from BlackRock who said that I would not invest in any property that is at sea level. And I think that is something to monitor. Cat losses are getting more frequent and more bigger by the year, and I think something to think about. Energy assets. I do not know how to price a coal mine anymore. How do you price it now? How do you price it 10 years from now? I think that's a question, that's sort of up in the air. I do not know what the price of used internal combustion engine vehicle is going to look like 5 years from now, 10 years from now, and today. So any companies that are playing in those spaces, any sectors that play to those spaces are, I think, definitely something that investors will have to very carefully tread upon.
Thank you. Kristen, I'm turning back to you. What Sachee touched on is this very delicate question of the timing of the transition. Our CEO is always talking about transitions can happen overnight. You need a realistic time frame. You can't go from dark brown to green. You have to go from dark brown to light brown first. How do you think about timing issues?
Right, there's a lot that we can do with that analogy, actually. But it's certainly going to take time to affect the transition. So as we go from dark brown to light brown to green, we can expect, of course, emissions to likely increase in some sectors. Just avoiding things that are brown, any shade of brown, for the moment, doesn't really help anyone, just to go straight into green assets. So that's why I think private capital is really pivotal to this transition. The long-term investment horizon that we have in private markets allows that change to take place. But also the sort of deep dive that you can take as a private markets investor to go in, set metrics, expectations for that investment to improve its performance or its profile over time makes perfect sense. But also the ability of private markets to really invest in the technology and the solutions that are necessary for that long-term change to take place is really unmatched in public markets. And so we need to allow time to invest in those technologies and allow them to scale to actually make the transition happen.
So, Sachee, I'm turning to you for another micro question. What has the greater potential for outperformance? A company that's already made the transition or is in a clean world, or one that's still on the journey? Which has the greatest upside?
It's probably not the answer you're looking for.
I'm not looking for it.
Okay, great then. We'll be open-minded.
I'm agnostic.
We'll be open-minded. See, even though I'm a public markets investor, I'm very, very long-term oriented. And I think what that does is that if there is a company that is not aware of the risk of not making the transition and does not have a plan in place to make that transition, I think they may be a very viable business for 5 years, but I'm frankly not interested in it. And I mean, there are so many examples that come to mind. But for example, if you think about it, I mean, there's a whole sort of subsegment in the auto industry, which is, batteries. Now, today, they are all making the lead acid battery because, that goes into the internal combustion engine vehicles. And they are facing an existential risk. If they do not acquire the technology and the manufacturing know-how to cater to the EV industry, they will cease to exist. Is the transition easy? And the answer is absolutely not. And some of these companies will not be able to make that transition. So I think as an investor, I have to be very careful that while I'm hopeful for the world, but when I do risk management for the portfolio, hope is not a strategy. And I have to be far more convinced of the transition happening rather than hoping.
And can I just add that
Please, Marina.
from a credit perspective, because we look at credit risks quite closely, being Fitch and looking at the fixed income market, we do consider the same kind of vulnerability and how it changes over time when you're looking at climate across different sectors, and within those sectors, subsectors and different operators within them, and it seems to be a fine calibration between when are you willing to take the cost, to sunk the capital to make that change, and where does that lead you in the long term, or how does that position you competitively over the long term. And it's a very difficult decision, I think, for any company, for any board of directors, for any executives to have to make, but these are decisions that are being made, for sure.
Yeah.
Marina, I'm going to ask you a question now. Turning to something that I think all of us think about a lot, which is, do the capital markets provide the right incentives when it comes to allocating capital to help us realize these goals, which many of us are concerned are not that realistic?
I think maybe, Kristen, you have something to say about that. I'll tell you from a very macro perspective, and I'd love to hear, Kristen and Sachee, what you have to say from a private and public side of things. There's an interesting, very stark division, if you follow the IPCC and the UN numbers, between transition financing and adaptation financing. The former refers to things like electric vehicles, renewables, things that as an investor or as a sponsor of a project, you have a commercial viability too. So you help the world transition, but you can make a profit while doing so. Adaptation financing, which is what a lot of emerging and frontier economies will need, is for things that probably won't generate much revenue. It's for a flood defense project. It's for other projects to guard against physical risks, which tend to be a lot harder to discern, the project risk, the construction risk, and even if it is, so they need a lot more public finance money or public money. They need a lot more multilateral, potentially support from the sort of supranational organizations. So I'll say that in terms of when we think about capital allocation, we also, and climate and specifically, we have to consider if we're talking about transition financing or adaptation financing. It's important to keep the two together because the physical impacts of climate risk need adaptation financing, and that is vastly underfinanced at the moment from the data that I've seen.
You've done a really very interesting job and raised a lot of interesting points. And we'll come back to this distinction and the distinction between developed markets and emerging markets and where you need public-private blended capital and subsidies. And this whole question of subsidies is very fraught. But Kristen, I'm going to turn it over to you now.
No, I think that was an excellent point because I think often what happens in this space is you look at risk and opportunity. And what I constantly look to talk about is the fact that we need $4 trillion a year. That's what the IEA estimated a couple of years ago, every year between now and 2050 to make the transition happen. So you can look at it in one framework, which is that's a tremendous and very compelling investment opportunity. So it goes to your first point in terms of the sort of transition opportunity set at hand. But then when you really couch it that it's a risk, so the resilience side, the adaptation side, that's maybe less compelling to a lot of investors, but that doesn't mean that it doesn't need to draw in capital. So as you look at those capital markets decision making, people will be drawn more to where they see increased risk reward and maybe more of the opportunity side rather than the resilience side, which certainly needs the capital. But I think that's why you need to draw in more partnership between private markets, governments, and partnerships there to really de-risk some of that capital moving into areas that need to build that resilience and adaptation side of the climate risk equation.
Chair, I'll take a shot at this question as well, because I think this is a very interesting question, and I'll answer it in two ways. So I speak to school kids, and for those of you who have kids, particularly teenage or high school kids, they're very passionate about climate change, and they are known, I suppose all over the world, they have all been part of some protests or some kind of campaigns. And my point to them is, you can raise these banners, you can protest all over the city, and you can do all of these things. You can do far more sitting on the side of table where I sit, where I'm holding on to capital that can be invested in these companies. You can hold the managements far more accountable by asking them the right questions and by penalizing them, if you don't hear the answers, that you would like to hear. And I think it's powerful. I mean, I'm a strong believer in democracy. I'm a strong believer in capitalism, and I think it works. It really works. And from the credit side, we have heard, that there's the end game, and then, there's the intermediary game. So I think there is definitely capital markets play a huge role in driving this to net zero to happen.
I'm going to come back to you in a minute, Marina, about one of the incentives that you mentioned in our conversation. But I'm just going to turn to you quickly, Kristen. One of the points that came up over previous panels was over time we will see technology accelerating the transition. Will we see that technology in new, younger companies that may be private first? Or will we see them in the big traditional conglomerates that have huge capital budgets already?
Well, actually, I think it's both, and I think that there's a need for a partnership. So we do see that those technology solutions and that innovation coming out of young startup companies. But obviously, markets are challenged right now. We heard earlier that private market valuations haven't quite caught up with what's happened in the public markets over the course of this year. So I think it actually depends on that partnership, where you expect some of the conglomerates who can't necessarily access that innovation, but absolutely need to do so, to really transition their business models, to change them over time, to make them sustainable for the next however 100 many years, or even between now and 2050. And so that partnership between those big kind of public companies and the private companies that are bringing that technological innovation is absolutely critical to push that forward.
Sachee, back to you. How much do you worry about technology risk? You're investing in public market companies. How much do you worry that they will be sideswiped by new companies with technology?
So I think in an Indian context, technology has been an enabler. And India, if you see, and China has been the same. On many different counts, they have leapt front, on many technologies. So for example, there was no way India would have been able to get a landline phone to every far-flung corner of the country. So when mobile technology came, it was absolutely, a boom.
Perfect example.
And we see this in so many other ways. And look, I like to believe need is the mother of innovation. And the worst part of developing markets, and particularly India, is that we are a net importer of energy, which plays very well into ESG, because there is so much innovation that is happening and that needs to happen. And that is the focus of people, to make industries, to make companies, to make basically urban sort of sectors less and less dependent on energy. And technology is an enabler in that. But I'll give you one more example. even legacy, what you would think as legacy, such as banks, right? Like banks are like dinosaurs in today's age, that we talk about. An Indian bank, for every $100 it earns, spends only $38 in expenses. That is your branches, that is your cash management, that is your people, that is everything. Of European banks spends around $70, $75, maybe $65 for every $100 they earn, because they are absolute dinosaurs. They're sitting on legacy systems, disconnected sort of core banking systems. They're still shuffling paper. They're still moving reams and reams of paper all over the world and backing it up. So technology, even in public sector companies, in a sector that is as old as banking, has been actually a beneficiary of, the banks have been a beneficiary of technology, which does not mean that every bank is going to survive or every legacy company is going to survive. But I think people who embrace technology will be far stronger than those that resist it.
Marina, I'm coming back to you now. This was one of the minor points that we talked about, but I loved it, going back to the incentives. And Fitch has done some very interesting work on litigation. Could you explain that to the audience? Because I wonder if they'll find it as interesting as I did.
Yes, so one of the themes that we started observing late last year was the rise in climate-related, or ESG more broadly, litigation. And
there's carrot and stick incentives here.
And what we started observing, and I'm going to link it a little bit to net zero and the transition, what we started observing was that litigation on an ESG or a climate-related basis was shifting somewhat. The strategies were shifting from restitution, financial restitution, to actually shifting a company's strategy. So you saw new actors coming in, primarily from civil societies or NGOs. The most famous case, which you may or may not have heard of, is Shell in the Netherlands that lost a case in the courts and was ordered by the courts in the Netherlands to shift its business strategy and accelerate its transition to net zero. And that was brought by a group of, if I'm not mistaken, a group of NGOs. And actually, what's interesting, what we're observing as we're looking at the sort of rising incidence of ESG-related litigation, is that it's becoming a way to shift corporate strategy. For us, that is a credit risk, if we're looking at the credit markets, but it's becoming a way to shift corporate behavior because, potentially the plaintiffs feel that, it's not happening through policy, it's not happening through litigation, so maybe it can happen through the court system. And that's interesting because for a company, if you get a fine, potentially you can move past it. If you're ordered to change your entire business strategy, that is a much more structural and kind of profound shift that is potentially happening. And actually, we've seen these sort of strategies, legal strategies, been deployed more and more. So it's something where we're keeping an eye on, and it's actually attracted quite a lot of interest in terms of where could this lead and where the dynamic is going.
This is the kind of unconventional incentives that I find so interesting.
I'm not sure the other side of the table will find it an incentive, but it's definitely, it's definitely something we're observing. And the more these disclosures around sustainability claims, certainly around the accountability of net zero claims is rising, and it's becoming should become a lot more robust. The other side of the coin of infusing this transparency into the broader sustainability market, the other side of the coin is that you might get more and more investors or other stakeholders saying, actually, I think perhaps I've been missold a product, or perhaps, the claims that were being made previously weren't as robust as, and then that kind of feeds into the litigation kind of trend that we're seeing potentially.
And that's a good segue now into the issue of data. So when I was getting ready for this panel, one of the great things about BlackRock is we have so many different pockets in the firm thinking about things, thinking of screens, thinking of data. So I was talking to Aladdin Climate, and all the issues about dating and reporting and disclosure. And I wondered how you think about these kinds of things. Are we moving to more consistency? Are we moving to more transparency? And to what extent is there clarity? Because many investors are confused, and is all this talk about greenwashing. And I wondered what your view is.
Well, it's actually an interesting link to the previous question or the previous point about litigation, because I think as you see increased scrutiny of particularly heavily brown companies, you're seeing them push into the private markets because they might think that they're not inclined to have to disclose as much in terms of their emissions profile or other important climate or sustainability KPIs. However, this is not the trend that will continue. I think that should companies go into the private space, we're likely to see increased awareness of what their profile actually is because of this emphasis on better data collection and reporting on sustainability, whether it's private markets or public markets. And so you mentioned Latin climate and what are some of the things that we're doing. So I think the first part is there's so much out there, but it's inconsistent and it's data that doesn't necessarily mean anything. So it's critical in the sustainability space to start with measuring what actually matters. So looking at a set of private companies and pulling out a set of KPIs and saying, okay, we're measuring that their water usage has increased or their emissions profile has decreased. Not measuring something where they have no impact on the environment or they have very little change, say, to their social practices or whatever it might be. So I think that's the first step. The second part is coming to some set of standards. And I do think the private markets are moving in a positive direction. There's been a lot of work in the last 2 years in terms of setting frameworks that are consistent among investors. Certainly, GPs will tell you that LPs are asking them for 25 different things. And so they're coming back to their investors and saying, can we see increased coordination among some of these asks to make sure that we're reporting on what's meaningful to you at an aggregated portfolio level. So we're working on our technology side through Aladdin, through eFront, and other systems to make sure that we're actually gathering that information in a consistent and standardized way and reporting that back to our LPs as well. Private markets are very difficult. Historically, that data has been very bespoke. It's portfolio company by portfolio company, building and asset by asset. So we continue to work towards that standardization and bringing in other sources of data, which we can then spread across our entire alternatives platform and really aggregate that again at the portfolio level to make it meaningful and useful to investors.
Thank you. Before I turn to you, Sachee, I'm going to turn to Marina. Nothing is one-dimensional, right? The war in Ukraine, Russia, which has come up a lot, means that people are focusing on resilience and security. And in some ways, do you see that as slowing the transition, as coming, this concern with resilience, is it coming at the cost of saying we need to postpone the transition? Resilience, protectionism, self-reliance. Nouriel talked about this a bit. How do you see that?
I was going to say we heard a lot about that in the previous panels, and whether you're referring to supply chains. So since the war in Ukraine started, what's become quite clear in the market discourse, in the energy space especially, is there seems to be a clear kind of bifurcation. On the one hand, energy security short term, but reinforcing commitment to decarbonization long term. And that's where the discourse currently is. I'm going to tie this to something that happened actually prior to the war starting, and that was on an EU level. The EU Green Taxonomy, or the European Commission, decided to allow natural gas and nuclear to be part of the EU Green Taxonomy, which is almost like a giant list of things that are considered sustainable. And that was very controversial at the time But again, as the geopolitical landscape has shifted, and as I said, this bifurcation between short-term energy security, long-term decarbonization has really become very entrenched in the discourse. I think it's interesting to see how attitudes to nuclear, and I don't know if you've seen it, perhaps have softened a little bit, because suddenly you're looking at sort of, a base load that was, I couldn't have said this a year ago. I could not have mentioned the word nuclear a year ago. You would have thought I was out of my mind by mentioning this. But now it's actually coming back into the discussion with the, let's say, institutional support of the Commission by saying, yes, potentially we can see it in the taxonomy as part of the sustainable investment buffet that we can offer. So that it's a market in a state of flux, but I am seeing reinforcement of the argument that decarbonization needs to happen, but over a certain time frame, because right now it needs to be about energy security for 2022, 2023, 2024 maybe.
We've seen countries like Indonesia ban exports of palm oil. You do see more strains in the world today. And you see strains, especially, in the emerging market, developed market thing, which is something you had referred to earlier. Sachee, this may be fair, it may be unfair, but I personally think of India, your home market, as kind of ground zero for climate change. India is heating up so much, so quickly. Our colleague said, and you referred to it, I would not buy anything at sea level. How concerned are you about India as India, that India may become uninvestable for ESG reasons, and that there is this compartmentalization? So I spend a lot of time in India. They are building this incredibly ambitious coastal road in Mumbai, your hometown, and I think it will be under rising sea levels before it's even built. How do you see this kind of compartmentalized thinking and countries becoming uninvestable because of ESG considerations? Very pessimistic question.
No. I think this is a very relevant question, and let me take this sort of, one layer at a time. So there's a study, and I think it's in Statista or somewhere you can find it. It's very publicly available. If the world's population lived and consumed the way Americans live and consume, we would need 5 Earths. If the world's population lived and consumed the way, let's say, British or Chinese, consume, we would need 2.5 times the Earth. If the world's population lived and consumed like Indians do, we would need only 70% of the present Earth. So that starting point is, I think, very sort of encouraging. And one of the biggest reasons for that is people don't have much, and vast swathes of the population is vegetarian. And we know that the land use of agriculture and all of that feeds massively into the ESG. But that's just one data point to think about. A second data point to think about is India today has around 400 gigawatts of installed capacity, of which 25% is renewable. India is still not sort of energy sufficient. I think there's a different word for it, but you get what I mean. By 2030, India is going to become 1,000 gigawatt of energy. I think the numbers are megawatt. No, gigawatts, right? And 50% of that would be renewable energy. That's huge. So from 25% today, because the energy needs are expanding, India will become 50%. To put this in context, the US today has 1,200 gigawatts of installed capacity, much higher than what India would have even 10 years from now, and only 25% is renewable. The point being, yes, ESG is a massive concern for a country, for India, but India has 1 billion people, 1.3 billion people, and I think they are already doing and have taken on far bigger sort of goals than perhaps what the Western counterparts have.
Okay, I'm going to stop you there because we have 1 minute left, and we're going to take one question from the audience, and then if you all have other questions, because we're breaking for lunch. Hopefully you can stop these people at the door. Zach, of course, thank you.
So clearly the role of finance, both private and public markets, in driving the energy transition by providing cheaper and more available financing to pro-transition investments and more difficult to access, more expensive financing to old energy investments has been significant. One space that remains in a strange dilemma, though, is mining. Ultimately, the energy transition relies on metals, relies on things that we need to pull out of the ground. But there seems to be little differentiation. Mining is subject to the same kind of increasing cost of capital of all kind of non-ESG investments. Do you see that as changing, and are you concerned about constraints in the availability of the natural resources that are needed to drive the energy transition until more economic and available financing becomes available for those resources that are necessary?
Such a yes or no, that's all.
It's been painted with the same brush, but I think as investors, we have to disintegrate that. The way I would manifest it, that while I do not invest directly in mining companies because they're just bad business models, but our banks and banks which we hold, if they are lending to mining companies because they are making that transition, pulling things out of the ground that are ultimately needed to, become sort of energy sufficient and ESG, sort of compliant, we will not stop them.
I'm going to cut you off there. I think our firm would say you have to distinguish between the upside of those who are making the transition more quickly and those who are not, and that goes from dark brown to light brown is an opportunity. Thank you all so much. Enjoy your lunch.